If you think the real danger in a crisis is that prices move too fast, you are still looking at the surface. The deeper danger is that most people enter the crisis owning the wrong kind of claim. They think they own safety. What they often own is exposure. They think they own value. What they often own is a story that only works while confidence, liquidity, and cheap energy stay in the room. Then the room changes. Oil spikes, shipping choke points matter again, inflation stops behaving, rates stop feeling friendly, stocks that looked unstoppable suddenly need a much better excuse for their price. And at the exact moment people should be calm enough to think clearly, they realize their portfolio was built for ease, not for stress. That is where wealth starts changing hands, not when television finally says the crisis is here earlier, when one class of people is being forced to sell liquidity, sensitive paper, and another class is quietly moving into hard assets, strategic commodities, cash-flowing businesses and price, dislocated opportunity. That is where I want to begin. Not with gold as a slogan, not with silver as a fantasy, not with one chart, one panic day, or one scary headline from the Middle East, with a structure. Because if you do not understand the structure, you will do what ordinary investors almost always do in moments like this. You will react to the wrong layer first. You will chase yesterday's move. You will confuse the quote on the screen with the ownership shift underneath it. You will try to become defensive after the people with better positioning have already spent months getting defensive before you ever felt alarm. That is how crises separate the prepared from the impressed. If you want the mother line for everything I am about to tell you, here it is. The unthinkable event around gold and silver is not merely that they could rise sharply in a new energy shock. The deeper event is that an oil-driven inflation wave, weakening paper confidence, and a late realization about real asset scarcity can destroy conventional portfolios at the exact same time that hard assets, select resource exposure, and crisis ready capital begin transferring wealth toward people who were positioned before the crowd felt fear. That is the line. Read it again. Because once you understand it, you stop asking the wrong question. You stop asking whether this week's price move proves the whole thesis. You stop asking whether gold is too high already. You stop asking whether a 60/40 portfolio that worked in one era must still be enough in another. You stop asking whether the crisis is really as bad as 1973 in some literal historical copy. You start asking the adult question, if an energy shock, an inflation shock, and a trust shock arrive together, what in my life actually benefits? What merely survives? And what gets slowly burned without me noticing until it is too late? That is the useful question. That is the profitable question. That is the question most people never ask because they were trained to think about money as a set of account balances, not as a structure of claims sitting on top of a real world of energy, transport, rates, policy, and scarcity. I learned a long time ago that most investors do not lose because they are stupid. They lose because they are comfortable. They mistake calm conditions for permanent conditions. They think the world that made a stock market portfolio feel effortless will always remain in place. Cheap energy, stable shipping, contained inflation, falling rates, passive inflows, central banks ready to rescue every stumble. That world trains bad habits very efficiently. It teaches people to believe that paper wealth is the default form of safety. It teaches them to think a retirement account filled with indexes is the whole answer. It teaches them that if something serious happens, governments, central banks, and the modern financial system will smooth it out before ordinary people ever really feel pain. That belief is one of the most expensive beliefs a person can hold heading into an energy crisis, because history does not say that paper claims always get protected first. History says the exact opposite. When real shocks hit, the assets closest to physical necessity and monetary distrust start behaving very differently from the assets that were priced for peace, cheap inputs, and perpetual confidence. That is why I want to talk about 1973. Not because history repeats in costume, it rarely does, but because human beings repeat their mistakes with astonishing loyalty. The surface changes, the sequence does not. Now let me start with the first mechanism. I call it the choke point tax. When most people hear about the Strait of Hormuz, they think in geography that is too shallow. A choke point is not a map feature. It is a pricing machine. It is a place where fear becomes cost faster than politicians can draft a statement and faster than ordinary people can reposition a portfolio. 1/5 of the world's oil moving through a narrow corridor is not just a statistic. It is a vulnerability disguised as routine. The reference document begins with that exact pressure point. And it is right to do so, because once a route like that is even plausibly threatened, the market is no longer pricing normality. Fay file site Fay turn 60 file 0 Fay that matters, because oil is not a narrow commodity story. Oil is transportation, oil is food distribution, oil is fertilizers, oil is industrial cost, oil is freight, oil is airline pricing, oil is inflation psychology. That is the choke point tax. The moment energy becomes more expensive, the modern world starts paying rent to geography again. Most investors forget this because they spent years in a regime where geopolitics felt like noise and supply chains felt automatic. That was a luxury. A crisis removes luxuries. A serious energy shock does not ask whether your portfolio was prepared emotionally. It reprices the real economy anyway. That is why 1973 still matters, not because every number will match, because the mechanism still lives. A geopolitical oil shock first looks like a commodity problem. Then it becomes an inflation problem. Then it becomes a rates problem. Then it becomes a valuation problem. Then it becomes a retirement problem. That sequence is what destroys people. Not the first headline. The fact that they keep treating each stage as isolated when in reality it is one chain tightening through multiple layers of life at once. Now let me take you into the second mechanism. I call it the paper wealth mirage. A lot of people think a 401k, an IRA, a brokerage account, and a rising market together spell safety. Sometimes they do. Sometimes they spell dependency on conditions the owner never bothered to identify. That is the paper wealth mirage. The reference text leans hard into the lesson of the 1970s by pointing out what inflation did to paper wealth, what a deep stock market drawdown did to retirement savers, and how long it took for broad equity holders to recover in real terms. The exact framing is dramatic, but the underlying warning is serious. A portfolio that looks large in nominal terms can still be quietly damaged for years if inflation and valuation compression hit together. Fay file site, Fay turn 60, file 0 Fay. That is the part ordinary investors fail to respect. They watch the account value, they forget to ask what the account is actually buying. A paper portfolio can look stable while your real purchasing power erodes underneath it. A paper portfolio can even recover nominally while your time, optionality, and inflation adjusted freedom stay far worse than they were. That is not a detail. That is the whole issue. A retiree does not live on nominal gains. A retiree lives on real spending power. A household does not feel up 8% if energy, food, insurance, taxes, and everything needed for daily life rose faster. That is why I do not worship nominal performance in inflationary systems. It flatters the inattentive. The paper wealth mirage is what happens when investors are trained to think the statement itself is the wealth, instead of asking whether the wealth is anchored to real claims, real cash flow, and real resilience under pressure. This is why a conventional portfolio that looked beautifully diversified during a disinflationary era can suddenly reveal itself as highly concentrated in one fragile assumption. That policy will remain friendly enough and cost structures calm enough for paper valuations to keep floating upward. If that assumption breaks, the statement is still there, the safety is not. Now let me say something harder. A lot of people own stocks and bonds together because they were told the pair protects them. In some eras, fair enough. But if an oil shock revives inflation pressure and keeps rates higher while equity valuations were already rich, the old comfort pairing can stop behaving like protection and start behaving like synchronized disappointment. That is when people discover that asset allocation is not a religion, it is a conditional arrangement. And conditions change. Now let me take you into the third mechanism. I call it the hard asset repricing. This is the part the public sees too late because the public is always most interested in hard assets after they have already started moving. The source file does what many crisis commentators do and jumps quickly from the 1970s to gold and silver's explosive performance in that era. The exact tone is promotional, but the valuable core is still clear. In a regime where inflation is high, trust in policy is thinner, and paper assets are repricing lower, hard monetary assets can behave very differently from conventional portfolios. Fay file site, Fay turn 60, file 0 Fay, that is the hard asset repricing. And it is not about worshiping metal for emotional reasons. It is about asking what kind of claim survives when confidence in paper claims weakens. Gold matters in those moments, not because it produces cash flow. It matters because it is no one else's liability. That sentence gets repeated so often that people stop hearing it. They should hear it more carefully. A bond is someone else's promise. A bank deposit is someone else's promise. A stock is a claim on a business whose valuation still depends on the cost of capital, the health of margins, and the stability of the broader financial regime. Gold is different. Silver is different in a more volatile way. Their behavior matters most not in calm periods, but when people start doubting the systems beneath those promises. That is why monetary metals wake up in certain eras and sleep in others. It is not magic, it is trust. When trust is abundant, yield wins. When trust thins, hardness gets repriced. That is what the reference document is trying to dramatize with the 1970s comparison and with its repeated warning that most ordinary investors ignore this relationship until the move is already obvious. Fay file site, Fay turn 60 file 0 Fay exactly. The public always wants confirmation before positioning. The stronger move is to understand structure early enough that you do not need public confirmation at all. Now let me say something colder. Gold is not primarily a growth asset. It is a regime asset. It behaves best when the regime beneath paper wealth is under question. That is why people who laugh at gold in easy periods often look terrified around it in hard periods. They thought it was a superstition. Then the cost of money changes, the inflation assumption changes, and the appetite for pure paper safety starts looking thinner. That is the hard asset repricing, not a trick, a regime shift expressed through markets. Now let me take you into the fourth mechanism. I call it the silver amplifier. Silver is where people usually get carried away because silver does something gold often does not do to the same degree. It combines monetary fear with industrial scarcity and speculation. That is a powerful and dangerous mix. The source material pushes silver very hard, calling attention to past explosive moves, current supply deficits, industrial uses, and shrinking inventory. Strip away the excitement and the structural point is valid. Silver is more volatile because it sits at the intersection of monetary demand, industrial use, and speculative positioning. Fay file site, Fay turn 60 file 0 Fay, that is the silver amplifier. A lot of people misread silver because they think it is just cheaper gold. Number silver is a more unstable expression of several forces colliding in inflationary stress. It can run harder in panic liquidation. It can also get hit harder. That is why silver rewards clarity and punishes romanticism. If you own it, you need to know why. Not because the internet told you it is overdue. Not because somebody drew a ratio on a chart and promised escape velocity. You need to know whether you own silver as a monetary hedge, as an industrial scarcity play, as a speculative amplifier, or as some blend of all three. Because if you do not know which role it is playing in your portfolio, you will not know how to behave when the move gets disorderly. That is where many people get destroyed. They buy silver for one reason and panic out for another. The silver amplifier is powerful because it can outperform gold in the right environment. It is dangerous because it can also become a machine that shakes out weak holders far faster than they expected. This is one reason Wall Street veterans care so much about sizing, structure, and purpose. A strong idea held in a weak way still hurts. That is especially true with silver. Now, let me take you into the fifth mechanism. I call it the gold oil signal. This is one of those relationships the public rarely studies because the public prefers stories to ratios. Ratios are cold, stories are entertaining. The market does not care which one you prefer. The reference document brings up the gold oil relationship as a signal that can tell you something about how markets are pricing stress before the full crisis is obvious. Again, the tone is more dramatic than I would use, but the instinct is sound. When two critical hard asset prices start moving in unusual relationship to one another, it often says something deeper about inflation fear, monetary distrust, and growth expectations. Fe-Felicite Fe-Turn 60 File 0 Fe, that is the gold oil signal. And it matters because oil speaks for cost pressure, while gold speaks for trust pressure. Oil tells you what the physical world is doing to your life. Gold tells you what the monetary world is doing to your confidence. When both start behaving in ways that stress conventional allocations, the old portfolio assumptions deserve fresh skepticism. Now let me be clear. I am not telling anyone to build a whole investment philosophy out of one ratio. That is not serious. I am saying relationships between key assets often reveal strain before headlines fully do. If oil is telling you cost shock and gold is telling you trust shock, you should not still be behaving as though your paper portfolio is living in a peaceful, low inflation, central bank friendly world. That is the point. You do not need a perfect signal. You need enough evidence to stop being complacent. The strongest investors do not wait for a perfect green light in crisis transitions. They look for structure. And structure is often visible in cross-asset behavior long before the public narrative catches up. Now let me take you into the sixth mechanism. I call it the inventory drain. This is where the story stops being theoretical, because one thing matters enormously in any hard asset story is the thing actually available. The source text talks about COMEX inventory, silver drawdowns, central bank accumulation, and tightening physical availability. Some of its rhetoric is sensational, but the useful core remains. When physical inventory gets tighter, while public focus stays on paper price movements, there can be a major disconnect between what the quote implies and what the stronger hands are actually doing underneath it. Fe-Felicite Fe-Turn 60 File 0 Fe, that is the inventory drain, and it is one of the oldest clues in commodity markets. A falling paper quote does not automatically mean weakening physical demand. Sometimes it means leveraged paper holders are being forced out while patient physical buyers are happy to accumulate into the disorder. That is a totally different event. If you do not understand that, you will spend your life reacting to the wrong layer. This matters more in silver because inventory tightness there can matter in industrial channels as well as monetary ones. But it matters in gold too, especially once central banks, sovereign buyers, and long horizon accumulators step up. This is why I never trust the screen by itself. I want to know what is happening to actual availability, what is being drawn down, what is being delivered, what is being withdrawn from easy circulation. That is the inventory drain. A chart is one sentence, inventory is another sentence, policy is another sentence, flows are another sentence. Only amateurs stop reading after the first one. Now, let me take you into the seventh mechanism. I call it the government delay reflex. This is where ordinary investors lose time because they keep assuming the state will step in quickly and intelligently enough to preserve their purchasing power. The state almost never moves that cleanly. The source document mocks the delayed and inadequate quality of political response in the 1970s and then jumps to today. Emergency reserve releases and policy gestures as if they will solve a structural oil problem. Beneath the flourish, the lesson is right. Governments are late, improvised, and usually more focused on calming headlines than fixing the underlying pressure. Fe-Felicite Fe-Turn 60 File 0 Fe, that is the government delay reflex. By the time a crisis is obvious enough for politicians to respond theatrically, the positioning advantage has already gone to whoever understood the structure earlier. This is why I always tell people not to build a defensive plan around the expectation of fast political competence. You may get lucky. You should not build on luck. Emergency oil releases, emergency speeches, emergency commissions, emergency letters, emergency promises. All of it is part of the same reflex: show motion, buy time. Restore confidence. Sometimes that works for a while. It does not erase the deeper condition. If the world is facing a real energy shock, then draining reserves is not a cure. It is a bridge, and every bridge needs to lead somewhere. If it leads to the same dependency, the same underinvestment, the same fragile confidence, then the bridge is not salvation, it is delay. Delay has value, it is not the same as repair. This is why institutional investors do not wait for the government's story to become reassuring. They ask whether the underlying imbalance has actually been fixed. Very often it has not. That is the government delay reflex. And if you understand it, you stop mistaking official motion for genuine safety. Now let me take you into the eighth mechanism. I call it the complacency window. This is where the greatest damage gets done. Not in the panic itself, in the period before the panic, when everybody assumes the old regime still deserves trust. The reference document says this directly in its own style. The biggest risk is complacency. That is one of the truest sentences in the entire file. Fay Phyllocite Fay turn 60 file 0 Fay, because complacency is what allows everything else to remain underpriced. Energy risk gets underpriced. Inflation persistence gets underpriced. Hard assets get underowned. Sequence risk gets ignored. Retirement portfolios remain built for ease. And when the break finally arrives, the public tells itself the move was impossible to see. It was simply uncomfortable to respect. That is different. A lot of people do not actually want early warnings. They want late permission. They want a warning that arrives only once the warning no longer asks anything difficult of them. That is what makes crises so powerful. They punish late permission. The complacency window is the period when oil is still cheap enough, rates still plausible enough, stock portfolios still calm enough, and daily life still normal enough that restructuring your portfolio feels socially unnecessary. That is precisely why it matters. That is the window where the strong reposition quietly, not because they know every detail, because they know the regime assumptions are changing. And once regime assumptions change, position matters more than prediction. That is the part retail investors keep missing. They think they need a perfect macro call. They need less fragility, less reliance on one outcome, less concentration in assets priced for easy conditions. That is how stronger capital behaves. Now let me take you into the ninth mechanism. I call it the crisis buyer, S-edge. This is where most people get the sequence backward. They think the money is made by panicking correctly. Not usually. The money is made by being liquid, calm, and structurally prepared enough that panic produced by others becomes your entry window. The source document hints at this when it talks about Wall Street insiders knowing how to use crisis. And while much of that language is promotional, the structural insight is still right. The people who win in major dislocations are often the ones who prepared before the crowd felt urgency and who know what to buy when everyone else is emotionally frozen. Fay Phyllocite Fay turn 60 file 0 Fay, that is the crisis buyer S-edge. And it does not belong only to giant institutions. It belongs to any investor who understands three things. First, that paper wealth can become fragile quickly. Second, that hard assets and dislocated quality businesses can become radically more interesting in stress. Third, that having cash, courage, and a plan before the crisis matters far more than being brilliant during it. That is why I never worship panic reactions. I worship preparation. A person who decides in the middle of the crisis that maybe gold matters, maybe energy matters, maybe balance, sheet strength matters, maybe valuation matters, has already surrendered the best part of the move. The stronger investor made those decisions before the crowd needed them emotionally. That is the edge, not prophecy. Preparation, that is a much more repeatable skill. Now let me say something even harder. A lot of people claim they want to buy when others are fearful. What they really want is to buy once fear has already been mostly resolved and social permission has returned. That is not the same thing. The crisis buyer, S-edge, belongs to the people who can act while uncertainty still feels impolite. That is why so few people capture it. Now let me step back and show you the whole machine. A geopolitical choke point threatens oil supply. Oil reprices the cost of life. Inflation fear returns. Rate cut hopes weaken. Paper portfolios priced for easy conditions lose some of their old protection. Hard assets begin repricing. Silver amplifies the move. Physical inventory matters more. Governments respond late and incompletely. The complacent get caught, the prepared get optionality. That is not one random market event. That is a crisis sequence. And once you see it as a sequence, the noise starts getting quieter. The real question is no longer, what did gold do this week? The real question becomes, what kind of regime am I investing in now, and is my portfolio built for that regime or the one that just ended? That is the only serious question. Now, let me make the identity flip explicit. Most people think protecting wealth in a crisis means buying the right thing after the crisis gets obvious. That is too small. The real edge begins earlier, when you stop building your whole financial life around paper comfort and start allocating some of your strength toward assets and structures that can survive distrust, inflation, and disorder. That is the flip. A spectator asks whether gold is up enough yet. A stronger investor asks whether his balance sheet is still too dependent on paper promises. A spectator watches the quote. A stronger investor watches the regime. A spectator wants confirmation. A stronger investor wants optionality. Those are different minds. The market treats them very differently. Now let me bring the operating system together in plain language. First, stop treating energy shocks as separate from portfolio risk. Second, stop assuming nominal paper balances equal safety. Third, understand why hard assets reprice when trust in policy and paper weakens. Fourth, know the difference between gold S-roll and silver S-roll before you buy either. Fifth, watch physical inventory and real-world cost pressure, not only the screen 6. Expect governments to react later and less cleanly than ordinary investors hope. Seventh, use calm periods to reduce fragility before panic turns pricing violent. That is the operating system. Not hysteria, not promotional excitement, not crisis cosplay structure. Now let me put the blade into this as cleanly as I can. The unthinkable event is not simply that gold and silver could rise hard in the next phase. The real unthinkable event for most ordinary investors is that they may discover too late that the portfolio they trusted was built for a cheaper, calmer world. While the people who studied energy, inflation, and hard asset regimes were already using the transition to move into stronger positions before the crowd ever felt the danger. That is the truth. And if you remember nothing else from what I said, remember this. Crises do not mainly reward the people who panic first. They reward the people who prepared early enough that panic belongs to other people. That is where the transfer happens. Be on the right side of it.